Hello, friends. Want to start managing your personal finance and dream to retire early one day? Today, we're going to dive into the world of personal finance and to explore the 5 very important fundamental rules of personal finance and investing. Whether you're just starting your financial journey or looking to level up your money management skills, these rules will set you on the path to financial success. So, let's get started. Rule number 1. Inflation is your biggest enemy. The first rule of investing is understanding the impact of inflation on your finances. Inflation refers to the rise in the general price level of goods and services over time. If your investments don't outpace inflation, the purchasing power of your money diminishes. Even if you keep your money there and do not do anything on it, the value of your money will be eroded because of inflation. That's why you have to start investing in any form of assets. Otherwise, you lose your purchasing power. Your money will keep on decaying if you don't do anything on it. The average inflation rate over the last 20 years in the United States is approximately 1.97%, and strike even to 9% in the year 2022. We have to find ways to overcome this 2% loss in order to maintain our personal life in the future. And the answer to that is by investing. Rule number 2. Time is your friend. The second rule of investing is recognizing the power of time. Time is your greatest ally when it comes to growing your wealth. The longer you stay invested, the more time your investments have to benefit from compounding. The process where your investment returns generate additional returns. By starting early and consistently contributing to your investments, you can take full advantage of the compounding effect and potentially achieve significant growth over time. Certainly, time is a critical factor in investing, and its importance can be understood from various perspectives, including compounding and other reasons. Here's an explanation. Compounding. Time plays a crucial role in the power of compounding. Compounding refers to the ability of an investment to generate earnings, and then those earnings generate their earnings, creating a snowball effect. The longer your money remains invested, the more time it has to grow through compounding. Over time, the compounding effect can significantly amplify your investment returns. By reinvesting your earnings, you not only earn returns on your initial investment, but also on the accumulated returns. This compounding effect becomes more pronounced the longer you stay invested. Long-term growth potential. Investing with a long-term perspective allows you to harness the potential growth of the market. While short-term market fluctuations can be unpredictable, over the long run, investments tend to grow. Historical data shows that stock markets, for example, have generally trended upward over extended periods. By giving your investments ample time to ride out the short-term volatility, you increase your chances of benefiting from the long-term growth potential of your investments. Risk mitigation. Time can act as a buffer to mitigate investment risks. When you invest for the long term, you provide yourself with the opportunity to weather market downturns and recover from temporary losses. Short-term fluctuations are a normal part of investing, but the longer your investment horizon, the more likely you are to overcome these fluctuations and potentially experience positive returns. Building wealth systematically. Time allows you to build wealth systematically. By investing regularly and consistently over a long period, you can take advantage of dollar-cost averaging. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach helps smooth out the impact of market volatility by buying more shares when prices are low and fewer shares when prices are high. Over time, this disciplined approach can help you accumulate a larger investment portfolio, capitalizing on the effects of inflation. Time is crucial for combating the eroding effects of inflation. Inflation erodes the purchasing power of money over time. By investing, you have the potential to earn returns that outpace inflation, enabling your money to maintain or increase its value. The longer your investment horizon, the greater the likelihood of finding investments that offer returns that outpace inflation. Rule number 3. Start early. Building on the previous rule, the third rule of investing is to start early. The earlier you begin investing, the more time you have to benefit from the power of compounding. whether it's through retirement accounts like 401ks or individual investment accounts. Starting early allows you to harness the potential of long-term growth and ride out market fluctuations. For example, assume we save $500 per month with a growth rate of 7% per year and compound it annually. If we do it for 10 years, the total sum will be $82,898 with a contribution of $60,000, a 38% growth. If we do it for 20 years, the total sum will be $245,972 with a contribution of $120,000, a 105% growth. If we do it for 30 years, the total sum will be $566,764 with a contribution of $180,000, a 315% growth. You can see the effect of compounding major wealth grow exponentially with time. So the conclusion is, don't wait for the perfect moment. Start investing as soon as possible. Rule number 4. Cut your debt. The fourth rule of investing focuses on debt management. Debt can be a significant obstacle to financial progress, as it often comes with high interest rates that eat into your income. Imagine you have a set of buckets, and your goal is to collect and save as much water as possible. Each bucket represents an area of your personal finances, such as income, expenses, savings, and debt. Now you start with a leaky bucket. When you pour water into the bucket, some of it slowly seeps out through the holes. No matter how much water you pour in, you're losing some of it due to the leaks. Before investing heavily, it's essential to prioritize paying off high-interest debt, such as credit card balances or personal loans. By reducing your debt burden, you free up more money to invest and improve your overall financial health. Rule number 5. Save an emergency fund. The fifth and final rule of investing is to save an emergency fund. Life is full of unexpected events, such as unemployment, illnesses, accidents. And having a financial safety net can provide peace of mind and protect your investments. Aim to save 3 to 6 months' worth of living expenses in a readily accessible account. This emergency fund will act as a buffer during challenging times, allowing you to avoid tapping into your investments prematurely or going into debt. You can also earn some interest by putting your emergency fund into some savers accounts that are readily usable. By following these rules, you'll lay a strong foundation for your financial journey. Remember, personal finance is a lifelong learning process, and it's crucial to continue educating yourself and adapting as circumstances change. If you found this video helpful, consider subscribing to our channel for more personal finance tips and insights, and leave your comments below. Thanks for watching, and I'll see you in the next video.